Okay, so let's continue then. We had discussed part one, cost of capital before new bonds are issued. So I told you just look at the old data. It had equity and debt, and then we just calculated the E&D and K and KD to get the cost of capital before the new bonds are issued. We've done this part as well. Okay. Now, I'm not talking about the report format because at this time, in the end, you know how to make a report. It's to, from, date, subject, the format of the report, you know. So I'm just doing the requirements. Second requirement, estimates the market value and yield to maturity of the new bonds. Now, it's talking about market value and yield to maturity of new bonds. Now, yield to maturity is an alternate name of KD. Yield to maturity is an alternate name of KD. So the question is asking you to find market value and the yield to maturity, KD, of the new bonds. We all know that for this, we have to only look at the new bonds. So I am just calculating the market value and yield to maturity of the new bonds. This is the information about new bonds. Okay. So I'm being asked that KINGTIM plans to issue 0.6 million, 7.5% new bonds with a nominal value of 100. So 0.6 million, this is the number of bonds. That's not dollar. It's not dollar 0.6 million. It's 0.6 million, 7.5% bonds with a nominal value of 100. Bonds will be redeemable in 4 years' time at a premium of 8%. Coupon will be paid on annual basis. Bonds are expected to have a credit rating of BBB negative. The issue of new 7.5% bond will not affect the market value of shares or the existing bonds. This bond issue will not affect the existing bonds or the existing shares. The market value of the new bonds will be determined by using information relating to KINGTIM's credit rating and the 4 bonds which government has issued to estimate KINGTIM's yield curve. So the market value will be computed using credit rating, BBB negative, and these 4 bonds which the government has issued. All bonds are of same risk class. The 4 bonds government issued are GTDR, its risk-free rate, redeemable in how many years, and the spreads are given. Okay. So I'm asked to calculate market value and yield to maturity of new bonds. Let's first calculate the market value of new bonds now. If you remember your topic discussed in weighted average cost of capital, okay, whenever someone asks you to find market value of bonds, it's simply the present value of 2 outflows of bond, that is interest plus redemption discounted at KD before tax. Okay, this is the definition of market value of bonds that's written in the book as well. Okay, it's the present value of 2 outflows. What are the 2 outflows? Interest plus redemption. These are the only 2 outflows of the bond. We pay interest on the bond, and that's redemption proceeds. These are the 2 outflows of the bond. The market value is the present value of these 2 outflows, and you just need to discount it at KD. This thing is computed on a before tax basis. Okay, so let's just start finding the market value of bonds using this. So this bond is redeemable in 4 years' time. So it will be 1, 2, 3, 4. This bond is redeemable in 4 years' time, right? So 1, 2, 3, and 4. It will run for 4 years. So when I'm asked to compute market value of bond, the present value of 2 outflows, interest, redemption. So this bond is continuing for 4 years, right? 2 outflows. Interest redemption. The bond is paying interest of how much? 7.5%. 7.5% of what? The par value 100. Interest is always been on par. So for 4 years, the first outflow which the company has to bear is interest. So when the question asks you market value bond is the present value of two outflows, interest redemption discounted at KD before tax. So this bond is redeemable in how many years? 4 years. So 1, 2, 3, 4. It's redeemable in 4 years. 1, 2, 3, 4. There are two outflows on this bond: interest and redemption. So interest is 7.5% of par 100. So interest 7.5. This is the first outflow which you have to bear on this bond. And redemption. Redemption is 4 year times at premium 8%. That means they will be redeemed at 8% premium to par, 108. You will net them up. You will get net cash flows of each year 7.5, 7.5, 7.5, and 115.5. These net cash flows are given. These are the present values of all outflows of the bond. So the bond has two outflows: interest of 7.5%, the new bond, and the redemption 108. You get net cash flows. To convert it into present value, multiply by the discount factor that is supposed to be KD. Okay, discount factor KD. Now, KD, you know when spread is given, you find KD as RF plus spread. Okay, so you have the RF of each year. It states the market value of the new bonds will be determined by using information relating to Kingdom's credit rating, this BBB, and the 4 bonds. The 4 bonds RF is given and the 4 bonds spread is given. So you will just do RF plus spread to get KD. Remember in your studies, when spread is given, you do RF plus spread. So 4% and spread is 56 basis points, 0.56%. So for the first year, the KD is 4.56%. For the second year, 4.3 plus spread is 0.78, 5.08%. For the third year, 4.7 plus 106 basis points, 1.06%, 5.76%, and 1.35%, 135 basis points, 6.55%. This is the KD RF plus spread I got for all 4 years. Now, once I have the KD of each year, how did I get the KD? Because to find market value, I need present value of two outflows discounted at KD. So the KD was not given. So I know when spreads are given, I do KD plus spread. So RF plus spread, we get the KD of each year. Now the discount factor formula, you know, is 1 upon 1 plus R power N. So for first year discount factor is 1 upon 1 plus R, 4.56%, power N is 1. Okay, so for the factor for first year, $0.956. Okay, I will not compute for each year, just giving you an idea. For the second year, it's 1 upon 1 plus R. What is the R for second year? 5.08%, and N is 2. .905. Okay, for the third year, 1 divided by 1 plus R, 5.76%, and power N is 3.845. And for year 4, 1 divided by 1 plus R 0.0655, 6.55%. Power 4. 0.775. Okay, so once these net cash flows are multiplied by discount factor, we end up getting present values. Once these net cash flows are multiplied by discount factor, we get present values. Okay. So 115.5 the last year multiplied by the discount factor, 89.61, then 7.5 into 0.845, 6.33, then 7.5 into 0.905, it's 6.78, and it's 7.5 multiplied by 0.956, 7.17. Do you think these are the present value of 2 outflows? Yes, these are the present values of outflows, interest redemption. You add them up, 7.17 plus 6.78 plus 6.33 plus 89.61. The present value of these 2 outflows, interest redemption, all future outflows, or the present value of 2 outflows, interest redemption, it's 109.89, and this present value of these 2 outflows, interest redemption discounted at KD, this is the market value of bond. This is written in WACC as bonds are trading at 109.89 by 100, like the old bond was trading at 104 by 100. This market value is 109.89 by 100. Okay, please copy it. Okay, now after you get the market value of bonds, you're also asked to find yield to maturity, that is KD. Now, when the question is asking you to find yield to maturity or KD, you all might have studied in your papers that to find KD, cost of debt, you have to see whether bond is redeemable, irredeemable, or convertible. So this bond is redeemable. So we will use the IRR approach. This bond is redeemable. So we will use the IRR approach. That's what happens with redeemable bonds, that whenever bonds are redeemable, to find cost of debt, we use the IRR approach. Okay, so let's apply the IRR approach to find the cost of debt, also called yield to maturity. Now, if we check this bond is redeemable in how many years? 4 years. So 0, 1, 2, 3, and 4. There will be 3 transactions on the bond. Investor will firstly purchase bond at market value and incur outflow from his pocket. What is the market value of this new bond? Just found 109.89. After purchasing the bond, investor will get after tax interest. So after tax interest is 7.5%. 1 minus 0.3. Sorry, 0.25, I think. Yeah. Because the interest income is recorded after tax, because 7.5% of par, 7.5, and you pay tax on it. 5.625, he will receive interest income. And then redemption. It's redeemed at 8% premium of par, 108. These are the 3 outflows which usually happens with a bond. So whenever the question asks you market value of the bond, we do this. Present value of 2 outflows, interest, redemption, discounted at KD. For KD for 4 years, we got it. The market value is 109.89. Then it asks yield to maturity, KD of the new bond. So for KD of redeemable, we use IRR approach. There are 3 transactions. Investor buys bonds at market value, incurs outflow from his pocket. What is the market value of the new bond? 109.89. Once he pays this amount and gets the bond, he gets interest income after tax, and then redemption 108. Net cash flows 109.89, 5.625, 113.625. Discount factor. For IRR, you can take any 2 discount factor. Let's suppose the first one I took 5%. Okay. Your 0 factor is 1. Your 4 factor is 1 divided by 1.05 power 4, 0.823. And annuity factor of first 3 years, you can see it from the table as well. $2.72. Multiplying these net cash flows by discount factor gives you present value 109.89, 15.32, 93.51. And if we net them all, the NPV is 1.05 negative. Okay. Now, if we got the negative NPV, we need positive NPV. For positive, we reduce the discount factor to, let's suppose, 3%. Here, zero factor is 1. For 1 to 3, 2.82. And for year 4, 0.888. So once this net cash flow is now multiplied by new discount factor, you get another present value 109.89 negative. $100.95 positive and 5.625 into 2.83. 15.91 positive. We net them all. We get NPV of 6.97 positive. Once you have the positive, negative NPVs, you put it in the IRR formula. Small a, the rate of positive NPV, 3%, plus capital A positive NPV, 6.97, where again positive 6.97 minus negative NPV, negative 1.05, to small b, rate of negative 5% minus positive rate of 3%. %, that's the yield to maturity IRR. To get the market value of bond and this yield to maturity KD, you get 7 marks for this. Okay, please copy this. Okay, so we have done the first part. Then the part B of report, we did the cost of capital requirement. Then we discussed this yield to maturity and market value of the new bonds. Then third requirement, estimate the revised cost of equity and revised cost of capital if new bonds are issued. You need revised KE and cost of capital, revised WACC if new bonds are issued. I have to explain you this thing in detail. Remember, you find current WACC of the company in part 1 before new bonds were issued. Understand the concept, please. You asked current WACC before the new bonds were issued. Now I made the WACC equation that before new bonds are issued, the company has shares, equity, and debt. Okay, so it had to incur two costs, KE and KD1 minus T, and all costs will be on their proportions. KE on equity proportion, E over equity, and KD1 minus T on debt proportion. Okay. When question asks you to find the current WACC before new bonds are issued, this is, I'm talking about B1. So when question asks you to find current WACC before new bonds were issued, so you said company has equity shares and the bonds. So KE and KD, you calculated KE, KD, D, and E plus D, that's it. Now B3 asks revised cost of equity and revised WACC if new bonds are issued. Now I want to find a revised WACC, new WACC if new bonds are issued. Remember, if new bonds are issued, what would be the WACC equation? If new bonds are issued, what would be the WACC equation? The company has now become financed through three sources: equity, the old debt, and the new debt. Okay, it's revised WACC if new bonds are issued. Now company has equity, shares, old debt, and new debt. So the WACC equation would be KE. Okay, KD1 minus T, old, I'm mentioning O, and KD1 minus T, new. Okay, these are the three costs which company has to bear if new bonds are issued, because if new bonds were not issued, before new bonds were issued, it had two things: equity, debt, KE, KD. Now if new bonds are issued, it has three things: KE, KD old, and KD new. WACC equation would be KE plus KD old plus KD new, and each cost will be on its respective proportion, right? Like K would be an equity proportion, which is E over E plus DO plus DN. Cost of debt on all that portion, that is all debt over all three. And new debt only on new debt portion, that is new debt over E plus DO plus DN. So if new bonds are issued, the WACC would be KE, KD old, KD new on the respective proportions. This means you must be able to find 6 things now to find the WACC. That is KE, KD1 minus T old, KD1 minus T new, E, DO market value of old debt, and DN market value of new debt. Once you have these 6 things, you can then find WACC. Okay, this has been discussed in detail in my classes in WACC, those who took classes from me, but those who are not taking classes and just seeing this video, we are trying to help you as much as we can. So once new debt is issued, the WACC equation would be KE, cost of debt old one, and cost of debt new one, because now you have 2 debts. You can even write 1 and 2, debt 1, debt 2, it's your choice. Okay, so once we make the equation, we need 6 things: KE, KD old, KD new, and EDOD. Now, what is E? It's market value of equity. So let's get back to the question. So number of shares 25 million into share price 5.56. Remember, 25 million shares into share price 5.56. 139 million. Okay, this is the market value of equity. Why? It's not changing. It's clearly mentioned that the issue of new bonds will not affect the market price of shares and the existing bonds. Okay, so number of shares into share price you can equally. Now, old debt, market value of old debt, it's at $0.45 million bond. 45 million was the bond's book value, trading at 104 by 100. So existing bond is 45 million, trading at 104 by 100. 46.8 million. This was also not changing. Okay. Now, market value of new debt. New debt is 0.6 million at a value of 100. That means 60 million of new bonds have been issued. Right? Because if 0.6 million, 100 bonds are issued, so new bonds book value is 60 million. And they are trading at 109.89 by 100, the market value which you just computed. $65.93 million. Okay. Cost of debt of old bond. After tax cost of debt of old bonds was 4.1%. And after tax cost of debt of new bonds, you have just calculated in the above part 4.7. So 5 things have been done. I just need KE now. Okay, so I want you to copy this 5 stuffs, and then we will finally find KE, and that would be it for this particular part. Okay, now for the last thing, that is KE. RF plus RA minus RF into beta equity. We all know that. Okay. RF plus RM minus RF beta equity. So if we check it, the risk-free rate of rate is 4% plus RM minus RF premium is 9% beta equity. You might argue that beta equity was given, which we used previously, 0.9, but this is where the problem gets created. This is for its existing garden center business. When companies issuing new bonds, it's not just keeping money, it's raising the new bonds and investing in a chain of outdoor shops. This will definitely change beta. Okay, because KINGTIM plans to invest 60 million. It's raising through the new bonds in non-current assets for outdoor shops. Currently, non-current assets of existing garden has 150 million value. It is assumed production proportion of book value of non-current assets, which will be invested in outdoor shops and garden centers, will give a fair representation of size of each unit. Whatever non-current assets are in each unit, outdoor and garden, they represent size of each unit. So outdoor is worth 60 million and garden is worth 150 million. And asset beta of similar companies in outdoor is 0.88. So what will happen now? Obviously, when you are launching outdoor, the beta equity will change. And for this, you have to perform a step called ungearing and regearing. Okay, in which you use the equation of beta asset, which is beta equity into equity proportion of the company plus beta debt into debt proportion of the company. Whenever you're entering into a new line, it's beta equity into equity proportion plus beta debt into debt proportion. You do ungearing and regearing. Okay, let's start ungearing. In ungearing, we find beta asset. Okay, but we don't have beta asset for this combined unit. For garden plus outdoors, we don't have this. Okay, we have beta equity of garden 0.9. You can get beta asset of garden from here. For garden, beta asset is, use this equation, beta asset of garden, beta equity of garden 0.9 into equity proportion of garden, it's 139 over 139 plus debt proportion of garden 46.8, 1 minus 0.25. There is no beta debt, so it will be 0 and the whole bracket will become 0. So 46.8 into 0.75 plus 139, 139 divided by the total 0.9, 0.72. This is the beta asset of garden only. This is the beta asset of garden only. Then we have beta asset of outdoor was given 0.88, right? Beta asset of outdoor was 0.88. 0.88, it was given. If beta equity of outdoor would have been given, I would have converted it into beta asset, but beta asset of outdoor is given, and now beta asset of garden is also given. We can now get a combined weighted average beta asset. Now company has 2 units, we can get a combined weighted average beta asset. The beta asset of garden is 0.72 and the size of garden is 150 million non-current assets over 150 plus non-current assets of outdoor 60. And the beta asset of outdoor is 0.88 into 60 is its size of non-current assets over 150 plus 60. This will give you the combined beta asset. This will give you the combined beta asset because 0.72 is for garden and its size is 150 over 150 plus 60. And the other is 0.88 because now company has 2. And 60 is its size. Non-current assets represent the size. 0.77 is the combined weighted average beta asset. Okay. Once you have the combined weighted average beta asset, now this weighted average beta asset represents both units. Why did I do this? Many people ask. Because when I'm adding some new things in the company, I have to do ungearing, regearing. In ungearing, I need beta asset, but I need a combined beta asset because now the company is based on 2 units, garden and outdoor. So I had the beta asset of outdoor. I found the beta asset of garden and then weighted average beta asset. Once you have the combined weighted average beta asset, this is ungearing, then you do regearing. Put this combined beta asset in new results. Put this combined beta asset in new results. To get beta equity. Now, if I use this equation again, combined beta asset is 0.77. I need a combined beta equity. Now, E is in the new structure 139. 139 plus debt in the new structure is now 2. 46.8, the old one, plus 65.93, the new. 112.73, 1 minus 0.25. Okay. If I solve this, I get beta equity as 1.24. I will say this is combined beta equity. Why? Because I put combined beta asset. I used combined beta asset, so I got combined beta equity 1.24. This reflects both units. I can put it in K RF plus RM minus RF into combined beta equity 1.24. 15.17%. I've got all 6 things. Now I have to just put it in WACC equation above to get the WACC following new bonds are issued. Okay, please copy it. Please copy so that I can put it in the equation and find back. Okay, now since these 6 things are done, you just have to put it in the equation of WACC, KE, KD, everything. You just have to put in the equation of WACC, and you can see and check that when we put it in the equation of WACC, our WACC comes to 10.4%. Our WACC comes to 10.4%. Okay, so you can calculate it by putting an equation. I have calculated all 6 values. Just put it in the equation. You get WACC as 10.4%. Okay. Now there is just one last calculation part in this. Estimate the impact of CEO's proposal on forecast after-tax earnings for the coming year. What is the CEO's proposal? Raise bonds worth 60 million, 0.6 million, $100 bonds, 60 million, and invest in outdoor sector. Okay, this was the CEO's proposal. Raise new bonds and invest in outdoor sector. Okay, estimate the impact of this proposal on forecast after-tax earnings for the coming year. Just 3 marks, very easy to form it. The CEO's proposal is proposal to expand the company's current limited sales by establishing chain of outdoor shops. Okay, this is the CEO's proposal. The establishment of chain of outdoor shops will be funded by debt. So, impact of CEO's proposal on after-tax earnings. Now, it plans to invest 60 million in non-current assets for the outdoor shops. Okay. It is estimated that the new investment will make a 10% pre-tax return. Okay. New investment will be 60 million in outdoor shops and will make a 10% pre-tax return. So let's find the impact of CEO's proposal on after-tax earnings. Now, CEO's proposals will result in earnings 60 million invested. They will give you 10% return. 60 million invested, 10% return, but that's pre-tax. Okay. $6 million. Okay. Tax will be paid at 25%. 1.5 million. So it will give post-tax return of 4.5 million. Okay, but this 60 million is not with the company. It will be financed by debt. So on this 60 million, we have to pay 7.5% interest as well. Okay, but this interest cost will also be after tax, after 25% tax. So this is gonna be $3.375 million. So CEO's proposal will result in a benefit of 10%, but after tax 4.5 million. But it will create finance cost as well, 3.375 million. So the net benefit of CEO's proposal would be a benefit of 1.125 million. It's so easy, and it's giving you 3 marks. Okay, you can copy this as well. Now there is one 10 marks requirement. That's 5. Discusses the impact on cost of capital and reaction of equity and bondholders to the CEO's proposal. Discussion should include an explanation of any assumptions made in estimates B1 to 4. Now in B1 to 4, if you have taken any assumptions, like in cost of capital, we assume beta equity remains constant, RF remains constant, RM remains constant, tax rate remains constant. So all those assumptions you can write, because we assume in fact that RF remains constant for the whole year, tax rate remains constant for the whole year, beta equity remains constant for the whole year, market value B2, it's the present value of all outflows discounted at KD. Okay, yield to maturity KD, we assume we calculated through IRR approach. Okay, so all these assumptions need to be written, but we have to discuss the impact on cost of capital and reaction of equity holders and bond holders to CEO's proposal. This is a general discussion. Like for example, it's 10 marks and you write 4 or 5 assumptions. You get 2 to 3 marks from that. Like see the assumptions, RF remains constant, our market return remains constant, beta equity remains constant, tax rate remains constant, KD is found through IRR approach. It's 4 or 5 assumptions, you gain 2 to 3 marks. Now for 7 marks, you have to discuss the impact on cost of capital and reaction of equity and bondholders to the CEO's proposal. You have to discuss the impact of CEO's proposal on 3 things: cost of capital and the reaction of equity and the reaction of bondholders. So yeah, it's 7 marks, and if you write 2 to 3 points on each, that's fine. So what is the impact of CEO's proposal on cost of capital? You know that in the first part, the cost of capital you computed was 10.1%, right? But after the proposal, the cost of capital became 10.4%. So that means after the proposal, the cost of capital has risen, primarily because beta equity, the risk factor has increased from 0.9 to 1.24. That means the risk factor has increased, and this is resulting in increase in cost of capital. What would be the reaction of equity holders? Now, CEO's proposal is based on further debt. Whenever debt is introduced, okay, these are the theories of WACC which we studied in WACC. Okay, so if debt is introduced, the equity holders say, oh, gearing is increased. Gearing increase means risk has increased. So if risk has increased, they want more return. This is their reaction. Plus, many equity holders say that they are raising new debt. That means company might face burden of repayments in the future. The profitability may go down, the earnings per share may go down, the dividend may go down. This is also a reaction. Some shareholders may sell their shares. That okay, company is now heavily debted. Leave it. Like previously, you can write all this stuff, right? Like that was, I think, 45 million approximately, 45.62, and equity was 139 million. So raising further debt of approximately 65 or 60 million, you see how much is going on. So the reaction of equity holders may not be good unless they are proven that this funds will be invested in a project which will generate huge returns. Bondholders typically don't react too much because bondholders simply know that, okay, company is raising further debt, whatever, we are going to get our interest. They don't have so much reaction. Okay, but overall, the cost of capital is rising. I would suggest you to read this answer from the examiner's answer. Okay, an examiner answer, all this is written. Okay, obviously you can never write all this stuff which is given in the examiner answers. Okay, but this just gives you a sound knowledge information which you can apply in the exam. Okay, so this is it with the question. Take care. Thank you very much. Bye bye.